Japan didn't fail because it was chaotic. It failed because it looked too safe. For years, Japan sold predictability, trains on time, papers stamped, nothing sudden. Capital likes stability, but it hates paralysis. Predictability calcified into ritual, motion without movement. Absence of disaster isn't opportunity. A museum is stable, a market is alive. By the 2000s, the system fossilized. 1980s governance, low mobility, punished risk. Foreign money looked in and saw an exhibit, beautiful, curated, untouchable. Approval upon approval. Nothing broke, so nothing changed. Slow certainty smothered innovation. A factory that never collapses and never upgrades isn't safe. It's obsolete. Returns told the story. Weak equities, deflation treated as normal. Reassurance over momentum. Stability became a trap. Safety became stagnation. Capital left quietly, not in panic, in disappointment. Failure began with the belief that standing still was a strategy. Japan didn't just fail to attract capital, it educated its corporations to push it away. After the bubble burst, firms hoarded cash to survive at any cost. A global investor sees excess cash as wasted potential. A Japanese executive sees it as moral insurance. When firms sit on mountains of cash, capital asks a simple question. Why am I here? Add corporate governance, cross-shareholding, friendly boards. In markets that attract capital, management fears shareholders. In Japan, management politely ignores them. For decades, Japanese firms delivered return on equity numbers that would get a CEO fired elsewhere. And nothing happened. No accountability, no pressure. Activist investors tried, but the system was designed to exhaust them with soft resistance and endless dialogue, followed by zero structural change. Japan didn't repel capital with hostility. It repelled it with politeness, inertia, and a system optimized for survival, not growth. Japan's reforms were like seasonal packaging, announced loudly, implemented gently, and quietly forgotten. The buzzwords were perfect: corporate governance, labor flexibility, startup promotion. But the reforms were theatre. Independent directors were often friendly insiders who knew which questions not to ask. Boards expanded, but power didn't move. Labor reform created a two-tier system that trapped talent, not freed it. Startups were promoted, but couldn't thrive when failure was taboo, and banks avoided risk. Capital doesn't fund vibes, it funds exits. When reform failed to generate returns, monetary policy filled the gap. The central bank couldn't fix the structure, so it anesthetized the symptoms with zero interest rates. Japan began to look like a market permanently on life support. Japan loves to explain everything with demographics: aging society, low birth rate, shrinking workforce, as if capital sees a population chart and immediately packs its bags. That's not how this works. Capital can live with aging societies. It invests in them all the time. What it cannot tolerate is an economy that refuses to adapt to aging. Japan didn't just age, it froze. Productivity growth stalled long before the population collapse became acute. Entire sectors remained protected, inefficient, and politically untouchable. Services lagged. Digitalization became a slogan rather than an overhaul. Fax machines survived into the cloud era like historical artifacts that nobody was allowed to throw away. An aging society should force brutal efficiency, automation, labor reallocation, immigration at scale, radical retraining. Japan did some of these halfway, carefully, and always too late. Immigration was treated like a temporary inconvenience, not a structural solution. Foreign workers were invited, restricted, rotated out, and socially isolated. Capital noticed the message: we want your labor, not your presence. That is not how you build a long-term growth story. Women were another missed lever. Japan talked endlessly about female participation while preserving workplace cultures that punished motherhood, seniority over performance, and face time over output. The talent existed. The system refused to use it efficiently. Then there's productivity theatre. Robots in factories made for great photos, but productivity in services, management, and decision-making remained painfully low. Meetings multiplied. Paperwork survived. Authority stayed centralized. Speed died quietly in conference rooms. Demographics didn't scare capital. Stagnant productivity did. An aging population can still generate returns if each worker becomes dramatically more productive. Japan asked fewer workers to maintain the same inefficient structures and then wondered why margins collapsed. This is where the inevitability myth becomes dangerous. Policymakers talk as if decline was unavoidable, as if no alternative path existed. Capital doesn't believe in destiny, it believes in incentives. And Japan's incentives told a clear story: protect incumbents, preserve hierarchy, delay adjustment, socialize losses through monetary policy, and hope stability substitutes for growth. It doesn't. By the time demographics became the headline problem, capital had already decided. Japan wasn't a future market, it was a managed past. Capital is not emotional, but it has memory. Japan didn't lose investors because of one bad decade, one policy error, or one demographic chart. It lost them because over time, it trained the world to expect nothing to happen. Markets are forward-looking machines. Once they internalize a narrative, changing it requires shop-level credibility. Japan offered continuity instead. Every promise of reform was followed by preservation. Every crisis ended with the same actors in charge. Every new strategy was absorbed into the existing bureaucracy and rendered harmless. Capital learned that even when Japan acknowledged a problem, it would not allow the solution to disrupt the system that caused it. Trust eroded quietly. Foreign investors didn't storm out, they reallocated. A little less exposure here, a little more elsewhere. Over time, Japan became a benchmark of underperformance, not dangerous, just irrelevant. That is the worst category in global finance. Once capital decides a market is structurally capped, no amount of short-term stimulus changes the conclusion. Cheap yen doesn't fix governance. Stock buybacks don't replace growth. Tourism doesn't substitute for productivity. And central bank support does not equal credibility. Japan's greatest failure was not economic, it was narrative. The story investors tell each other matters more than any white paper, and Japan's story became painfully simple. Safe, predictable, low return, no catalyst. Capital doesn't argue with that, it moves on. This is the part policymakers still misunderstand. They think capital will return when conditions improve marginally. It won't. Capital returns when it senses regime change, not adjustment. When insiders lose power, when failure is allowed, when inefficiency is punished in public, not managed in private. Japan has not crossed that line. Not yet. Until it does, capital will treat Japan the way it treats a former champion athlete now selling nostalgia. Respectful distance, occasional visits, no long-term commitment. The tragedy is not that Japan failed to attract capital, it's that Japan taught the world, very patiently, not to expect anything from it.